If you weren't able to come to the in-person seminar on September 12th, today I want to record some videos going over the slides so you have some context of what was being discussed. We're not going to go over everything in verbatim, but to give you a high-level view of what was being discussed is ultimately the goal. So first and foremost, the general seminar is out long-term investing in a rising interest rate environment. So to that extent, here's our disclaimer. We broke the seminar down to three sections: inflation, the bond market, equity market outlook, and the psychology of staying invested. For the purpose of these videos, I'm going to break them down in even smaller chunks. So the first video, this video that you're watching, is going to go pretty much over inflation and the interest rate environment today. Next video, go over the bond market, equity market outlook, and then psychology of investing, all in separate videos. So without further ado, bond performance and inflation outlook in a historical context. This first slide, we're looking at the yield curve. A yield curve is essentially a breakdown of what interest rate looked like when you're going from 0 months all the way out to 30 years. And what we're looking at here is that this gray line is where interest rates were at the end of 21, green line is 22, and then the blue line is where we were at the end of July 23. And what we see is that the biggest changes that happened from last year to this year have happened on the short end of the curve as the Feds continue to raise rates. The long end of the curve has not significantly changed since the beginning of the year. And obviously these numbers go through July. As of today recording, interest rates haven't significantly changed from these levels since July. Obviously, a lot has changed since 2021. And this change, this jump in rates from 21 to 22 is what caused all the pain in the bond market during that time period. As interest rates rose, bond prices came down. We've seen a lot more stability in the bond market this year on the longer end of the curve. Short-term rates, again, have continued to rise. And I should say on this slide, this gray area represents the range of different yields that we've seen along the way over the last 10 years. And a lot of these lowest rates were at the bottom of COVID when the 10-year got down to 0.5%. People were locking in their mortgages at 2.3 out here. But essentially what we're seeing here is this is the range of outcomes over the last 10 years. The lowest rates were during COVID, and these highest rates are very, very close to where we are today. Inflation update. Obviously, the thing that was inflation for the last decade or more, since 2008, the Fed has lowered rates down to zero. They've been doing a bond buying program, all with the goal of creating inflation. I shouldn't say all with the goal, but a primary goal was to create inflation in what was otherwise a relatively deflationary environment. And so what we saw was that if this chart would go back, you would see that these rates, the inflation rates, were relatively well contained, 2% or less. And then we had COVID. And so we had a big demand and supply imbalance that was created from the COVID shutdowns. And then as everything was opening back up, you had the Omicron variants shut down China, then you had Russia invading Ukraine, and you had all these factors that went into creating what turned out to be significant inflation. So from 2021 into 22, we saw that inflation rose up to above 8% down here. And then in 2023, we've seen inflation come down significantly. We're projected to be on track for about a 4% year-over-year inflation rate. Now, this is the FOMC's target rate. So they always do these dot plots here where they look at where they project interest rates to be going forward. So this is a chart from JP Morgan Asset Management, but basically it's just taking the federal funds rate today, which is this dark gray bar, and then we have the market expectations, which is these green dots, and then we have the FOMC year-end estimates, which are these blue dots, and then you have this long-run projection where the Federal Open Market Committee thinks that interest rates will be in the long run, and they think that rates are going to get down to 2.5 again. Now, the market is saying that towards the end of this year, we are going to see that the short-term rates are actually a little bit lower than they are today. Certainly by 2024, we have rates down here in the 4% range. By 25, we're at below 4% is what market expectations are. If we look at the Federal Reserve's estimates, they think would be up to about 5.6% by roughly year end, with rates dropping much more quickly, so that by the time we're in 2025, rates are back down to 3.4 on the short end with a steady decline back down to 2.5. This all sounds very official, But on this next slide, I want to point out that when I did this seminar earlier this year, I was looking at this slide here, which had the same chart showing the December 2022 figures. And the Fed was predicting a much lower rate for year end with a much faster decline. And if we go back to the September, when we looked at this last before that, the Fed was never predicting that rates would get above 5%, and they thought we would see a much more stable yield curve with rates dropping down still to that 2.5 projection long term. So again, I highlight these two charts just to say that the Fed is not infallible. These estimates change on a regular basis, and they're essentially estimates. So if we get down 12 months from now and it turned out the Fed was entirely wrong and the market was entirely wrong, well, it wouldn't be all that surprising. It certainly wouldn't be the first time that the Fed or the market has been wrong on this topic. Now, this slide here, we're looking at the time from the last interest rate hike to the first cut. As I'm talking, we don't have any exact knowledge that we've already seen the last rate raise, but it's entirely possible. If the numbers come in such that the Fed doesn't raise rates again, the next question is, how long before they start lowering rates? And so when we look at that in a historical context, typically from the time that they raise rates to the next cut has averaged about 10.5 months if we go back to 1994. The shortest was 6 months. The longest was 18 months. So again, if it turns out that the Fed has already had its last rate raise, we'd be looking at something between a half year and a year and a half before we'd expect them to start lowering rates. If they still have one more rate raise, well, that extends the clock a little further. But ultimately, the important point to note here is that when the Fed finishes raising rates, historically, the rates don't just stay there. Eventually, the Fed does start cutting rates as it starts to execute on its plan to keep employment levels and inflation inside its parameters. So with that being said, I'm going to stop this video here, and the next video is going to go on to the bond market and our expectations that we have going forward. If you have any questions about inflation or interest rates, please let me know. Otherwise, skip over to video 2 and we can keep going. Thanks.